Hey everyone, how's it going? It's Russell here, and it was just revealed that months ago, the Finance Department of Canada was warned about a major threat that could impact every single Canadian. And whether it's potential housing market correction or the likelihood of whether or not the government will create further benefits like the CRB and other social supports, or whether the government will even be able to pay down its massive debt, this affects absolutely everyone. So in today's video, we're going to talk about exactly what this warning was and the sketchy reason we didn't hear about it at the time, as well as what this means for you and how you could potentially use this information to protect your money or maybe even make a little bit. But before we do, make sure to subscribe to the channel if you haven't already done so, and check out all of the links in the description. Whenever you use those links, you're directly supporting more Canadian content being created just like this on the YouTube platform. All right, let's get into exactly what this warning that was given months ago to the Department of Finance actually was. It's no secret that the prices of absolutely everything in Canada have been going up, and it's been more and more expensive to live in this country over the past couple of years. In fact, we are currently seeing an inflation rate, or a CPI index rate, of 4.7%, and that's the highest rate of inflation since back in the 80s. That essentially means that every dollar you have and every dollar you work for has 4.7% less purchasing power. It can buy a lot less with the same amount of dollars. And this makes me think of something that's been seen on Reddit quite a lot lately, and it's the sentiment that if you're not getting a raise that equals at least inflation, well, you're actually getting a pay cut every single year. I'm sure you're familiar with how frustrating this can be, especially when Canadian banks are only offering in their savings accounts less than 1% on the money that you're saving. Now, are you really saving any money if you have inflation near 5% and are only earning under 1% in those savings accounts? Well, this is something that's super frustrating, and it's something that the Finance Department of Canada was warned about all the way back in May. Take a look at this headline that is just out today. I'll move myself down here so you can see more clearly. It says that documents have been revealed that are going to give a glimpse of the Finance Department's outlook, and as well the warnings on inflation that they received all the way back in May. Back when Chrystia Freeland and the Finance Department received these warnings in May of 2021, inflation was at 3.6%, which even then was far above the healthy inflation rate target that the Bank of Canada has set of 2%. We were already 1.6% above that target. So why didn't they do anything at the time when they received this warning? Well, this was because the Government of Canada, as well as the Bank of Canada, blamed this runaway cost of living increase on two things. And they said that those two things weren't going to be around for a very long time. The first one was base year effects. Essentially, at the time, Tiff Macklem, the Governor of the Bank of Canada, said, hey, this high inflation rate that we're seeing right now, it's not actually a high inflation rate, because when we look at this rate, we're actually comparing it to a year ago at the beginning of the pandemic, when we saw record low inflation, extremely low inflation, even entering a deflationary period. So when we compare these normal rates that we have today back to what they were previously, well, that'll give us an inflated amount of inflation. No pun intended. So they said we don't really need to worry about inflation because the only reason we're seeing it is because of the way that we measure it. And the second reason they thought that this would just disappear and go away is that they thought that this was going to be transitory inflation due to supply chain bottlenecks. Now, transitory just means that it's here today and is going to be gone tomorrow. It's very short term, and they thought that this was because of the supply chain. We saw various closures because of COVID, meaning that it was harder to transport goods, and that made goods more expensive. So they said, hey, once COVID is solved, well, the supply chain bottlenecks will go away, and this inflation will rapidly go down, and we're not going to have to worry about it. So maybe we won't tell the Canadian public that we're being warned about this inflation, because we personally believe that it's going to go away without us even doing anything. But some, including myself, would actually say that the Bank of Canada was a little bit devious in what information they talked about and what information they didn't. You see, many people will argue that this increased cost of living is a result of the Bank of Canada itself adding a whole bunch of new money into the system. And in fact, they added billions of dollars every single week through a program called quantitative easing, essentially trying to stimulate and prop up the economy. Well, now that we're seeing these dollars trickle into the economy, all of this new money, well, that new money has to go somewhere somewhere and it goes straight to the cost of goods, because more money to spend means that more people will spend that money, and when there's more demand and there's the same amount of supply, well, you can see where I'm going. The price is going to go up on practically everything. But inflation is just one side of the problem, and the other side of the problem is actually what many people are touting as the solution to the inflation problem we're seeing. You can see here that a rate hike, an interest rate hike, is expected from the Bank of Canada after a report that was rather hawkish, essentially meaning not very optimistic about the future. But this potential solution could cause a whole host of other issues, such as a housing market correction, personal bankruptcies, and actually even raises the question of whether or not the Canadian government will be able to pay off its massive debt. You see, the Bank of Canada thinks that it can slow down inflation by increasing interest rates. The idea is that when we increase interest rates, people are able to borrow less, or at least it's more expensive to borrow money. As a result, there's less borrowed money circulating, and less people are incentivized to go out and spend that money. Now, if we have less people spending money and less demand for goods and the same amount of supply, well, that should slow down the price increases we're seeing across the board. On top of this, when interest rates go up, well, so do the savings rates inside of Canadian banks. So if savings rates go up, people are less incentivized to spend their money now because they can expect at least a slightly better return on the money that's in their interest-bearing savings accounts. But while this may ease the rising cost of living in the short term, it may also have some dramatic impacts on the real estate market in Canada. You see, when interest rates go up, well, the same happens to mortgage interest rates. And when mortgages are more expensive, or you have to pay more interest on those loans, well, people are able to borrow less money with the income that they use to qualify for that mortgage. Now, as a result, there's less demand for houses on the market. And what have we been talking about this whole time? When there's less demand and the same supply, well, prices tend to stagnate, or in some cases even start to go down, and in extreme cases go down dramatically. And homeowners that have a variable rate mortgage, or essentially a mortgage where the interest rate can go up and down based on what the current market interest rates are, instead of locking it in at one rate over the course of 5 years, well, for those individuals, if rates go up fast enough, they could end up having to make larger mortgage payments. And in certain situations, they may not be able to make those mortgage payments and may be forced to sell their homes. Now, as a result, that increases the supply. And again, we have less demand because of the interest rates that allow people to get mortgages, and more supply because of people who need to sell because they can no longer make their payments. You can see where I'm going with this. And this could also have a major impact on the government itself. You may already know that the government of Canada has a huge amount of debt. We can see it right here. It's chiming in right now at $1.2 trillion. And just like any other debt or any other loan that you have, the government of Canada has to pay interest on this money that they've borrowed to fund the entire operations of the government. You see, in most cases, the taxes that we pay as Canadians, which many people believe fund all of these government programs, well, the taxes we pay aren't enough to pay for those programs. Instead, the government uses our tax revenue to pay to service its debt, or to pay the interest rates on the government's debt. And that's all well and good for now, while our tax revenue is higher than the amount of money they have to pay for the interest payments on the total $1.2 trillion of debt. But what happens when interest rates rise? At some point, the government has to renew this debt, and potentially will have to lock it in at higher interest rates. Now, if that rate goes up enough, well, we could reach the sort of precarious position where the tax revenue that the government collects from all of its citizens isn't high enough to even service the debt, or to just make the interest payments on the loan, let alone start to pay it down. This affects everyone because as interest rates rise, the government will be less likely to take on more new debt. And without taking on more new debt, well, they won't be able to implement new and existing social programs like EI and the CRB and other sort of benefits. And certainly a UBI would be less likely in this situation because the government won't be able to take on as much debt because interest rates will be higher. You can slowly start to see how this is going to have a trickle-down effect that's going to actually impact everyone. Now, we likely won't see the effects of all of these changes for a few months. It takes time for this to actually show up in what we're seeing in the data and in the numbers. But one important thing to look out for is next week when Tiff Macklem, the governor of the Bank of Canada, announces whether or not and how much they're going to be raising interest rates by. Now, this raises the question, what should you be doing with your money in this sort of situation? Now, of course, I have to make the disclaimer, this is not financial advice in any way, merely research for you to do your own research and make your own decision. It's not financial advice, but here are some thoughts on what I think might potentially happen in the future and how you might be able to take advantage of it. If you're someone who thinks that investing in things like the stock market is just a little bit too risky, well, then there is one positive side of all of this for you, and I mentioned it before. It's the fact that savings accounts, and specifically high interest savings accounts across Canada, if interest rates go up, well, the rates inside of those bank accounts, those savings accounts, will go up as well. I always recommend that people have an emergency fund of roughly 3 months of living expenses if you possibly can, and to keep it inside of a high interest savings account. Now, if you're able to stockpile this money there, you'll at least be making a little bit of an interest rate return on that money, but likely it will still be lower than the current inflation rate. Another option is to potentially invest in broad-based index ETFs, or exchange-traded funds, that are less tied to only the American and Canadian economies. Now, over time, this could potentially preserve your wealth more than leaving it in a savings account. And of course, this is all stuff that we talk about in the Canada Money Mastery program, where we learn all about preserving and building wealth here in Canada. If you're interested in that and it sounds like a good fit for you, there's a link in the description where you can learn a little bit more. Or if you're fed up with the current monetary system altogether, given that it can be so easily manipulated by the government as well as central banks across the world, well, then you might want to consider decentralized cryptocurrencies like Ethereum and Bitcoin. This is something I've leaned into far more heavily as of late, but if this is the route you're going, beware that there could be a lot of volatility or the prices going up and down dramatically over the short term. While I think investments in these types of things over the long term will certainly outperform other options, over the short term, the price could go up and down dramatically and for an extended duration of time. So make sure to only invest money that you are willing to potentially lose. So obviously there's a lot going on here, and I'm sure you have a lot of opinions about it, so if you do, let me know what you think down there in the comments section. And while you're down there, again, check out all the links in the description. Whenever you use any of those links, you're directly supporting the creation of more content like this on the channel, focused on Canadians specifically, which I think there's not quite enough of. But with all that said, thanks so much for watching, everybody. I really hope this video has helped you out at least a little bit, and I'll see you next time.